Welcome back to Fulfillment Unpacked, the show where we bring together 3PL operators and industry leaders to share real stories and practical lessons for running a smarter, more fulfilling warehouse. I'm your host, Scott Harward. Today I'm talking with Nate Schisler. Nate's the co-founder of Maven Circular and runs MFR, a specialty 3PL focused on returns. Before that, he spent years building warehouses for big brands like Lululemon. Then he took the leap, bootstrapped his own 50,000 square foot operation, and grew it from scrappy beginnings into a serious business. In our conversation, we get into what it really takes to start a 3PL without outside money, how the cheap option can sometimes cost you the most, and why seeing returns as cash can change the way you think about your business. Welcome to the episode, Nate.
Thanks for having me. Great to be here.
Let's get started off by having you introduce yourself.
Yeah, my name is Nate Schisler, co-founder of a company called Maven Circular, which is a consulting and advisory services company focused in the world of reverse logistics, resale, and re-commerce. We also have a services division called MFR, which is a specialty 3PL services company that specializes in returns processing and getting items back to a resellable state.
So how'd you get into this industry and get started into the 3PL world?
Yeah, in 2020, my kind of like COVID existential crisis was I quit my corporate job and started consulting. You know, I felt like I had really had like a really solid like 7-year run with a company. I wanted to do something different. I didn't know what that was. So I kind of like jumped without a parachute and started providing like fractional supply chain executive services to some small brands in the greater Vancouver, Canada area where I was living at the time. And then we had a client come along that we assisted with an RFP to find a specialty 3PL. They had been self-performing their operations in the re-commerce space. And at the conclusion of that RFP activity, they approached us and said, like, we know you guys know how to do this. Would you just become our provider? And after some discussion, some heated discussion with my wife, we went and leased a warehouse and became a services provider. And then we've just started growing that business. And really, it's kind of gone from like 80% consulting, 20% services to really kind of like flip-flop the other direction, where now the services business is kind of the core of what we do every day. We're now out in the market working for folks who didn't know that we also consult and advise in the space.
That's really cool. As you got started, how did you end up setting up the infrastructure and to start building the warehouse? You did a lease for the warehouse, and where did you go from there?
You know, I spent the first 20 years of my career building warehouses for other people, for other companies. And when you think about like spending capital dollars or making capital investments, when you're a project manager for, say, Lululemon, you know, the cost of capital infrastructure is just a number on a piece of paper. It's very different when that number has to come out of your bank account. You have a very different relationship to the decisions you make when you open up an operation. And so, I mean, we didn't take on investors. In fact, we really didn't take on any long-term debt. We really kind of bootstrapped our way into our first facility, which was just shy of 50,000 square feet. And, you know, there's a couple things that contributed to the success there. One of them was that we opened the warehouse here in Columbus, where I've worked most of my career, and I have a lot of contacts here in the industry that provide used equipment, everything from used, you know, pallet jacks to used racking to everything in between.
Yeah.
So having that like really strong Rolodex and opening in a market where I knew a bunch of the players, and then also, frankly, like we sourced so much equipment from Facebook Marketplace. I mean, I like to joke that like we opened an entire warehouse, you know, from Facebook Marketplace. And I think the key like tip to making that work is not being too rigid in what your infrastructure needs to look and or feel like. You know, so when you think about a warehouse and you really distill it down to its like core elements, it's tables and technology and storage. Does that storage have to be teardrop pallet racking uprights, or can it be wide span particle board shelving? Do the tables have to be 36 inches deep, or can you live with tables that are 30 inches deep? And so, you know, it's really like peeling back the requirements to their kind of like most base level and understanding like, what are the things I need to make this functional and what are the trade-offs I'm willing to make? Yeah, everybody wants brand new shiny pallet racking in their warehouse, but is it okay if the colors are mismatched and the beams aren't all the same color, and in some cases not even the same sizes? Like, and that's the reality of like our first building. It was very scrappy in its appearance, but now we're not sitting on a boatload of debt from going out and, you know, taking out a loan to, you know, what would have cost us probably $2 to $3 million in infrastructure, we probably were into that building for 10% of that cost, just sourcing creatively.
Yeah, that sounds like a really interesting way to get started. What were some of the things that became obstacles about that strategy as you grew?
Yeah, in the very, very early days, there are some things where I can look at a decision and say, we should have been more aggressive. So I'll give you a very specific example. We had an opportunity to basically write one check and buy all the racking we needed for the storage half of the building. It was about 25,000 square feet. And that check would have been on the order of $200,000 or $250,000. So $10 a square foot for full infrastructure build out. And that is just absolutely dirt cheap. But the thought of making that level of commitment early was really terrifying. And we just drug our feet. And what made this a really economically viable opportunity was that there was a warehouse about 5 minutes away from us that was being torn down, and we knew the contractor doing the work. And so we could have, if we had made the decision early enough, they could have literally just torn it down at their building and trucked it to our building and set it right back up, and it would have been fine. And so very economical for, both parties. But the thought of writing a check for that amount of money, or frankly, trying to go get a loan as a new business for that amount of money, we didn't pursue that aggressively enough. And so the consequence of that is that for the first few infrastructure purchases we made, were really mismatched out of desperation. We need 2 more aisles of racking, and what can we find in the market? And a couple years into that, we were in a position where we could say, okay, let's get rid of all this old mismatched stuff because it's starting to cause a problem. And, we were able to liquidate it and go buy, a match set of used racking and rework the warehouse. So that's an area where I wish we had been a little more aggressive, a little more assertive, or a little more self-confident to say, we're buying this stuff at such a good price that if things don't work out, we know we can get rid of it. So let's go, go big or go home today. And the actual ramifications of that, other than just being a little annoying for a year and a half, were not that significant. But if I could, talk to my younger self, I would say go find the money to make that purchase because it was such a good deal.
I feel like those decisions are hard to make, balancing cash flow, with risk, and just trying to make sure everything goes smooth. But that's kind of hard to do in this industry.
Yeah, you almost have to, if you're going to bootstrap your way into building a 3PL, you almost have to take on the mindset of a reseller. You almost have to know what's the outcome of those capital purchases at the end of their life or at the end of their usefulness. And if you can work that deal backwards, and if I had done that analysis, said, look, I'm buying this stuff for 10 cents on the dollar, I know that it's worth 40 cents on the dollar in the open market. So this is a really safe purchase. Even if our business goes belly up, I know I can get out of this purchase. Just really thinking about that purchasing decision through the lens of what is the value of the thing I'm buying at its end of life? And is this a safe purchase or a risky purchase? Adopting that mindset is how we think about making those decisions today. If things go south, what's my exit strategy? And if my exit strategy is favorable, then let's take the risk and write the check.
Right. So before you started the 3PL, you consulted and you had jobs that you helped consult with warehouses.
Yeah.
What happens when the cheapest option turns into one of the most expensive mistakes?
Well, hopefully you learn something from it. I mean, if you're not learning something from that outcome, then you're going to keep making that mistake. Something that comes to mind is when I was working, again, this is like a COVID story. I feel like we have a few of the few 2020 COVID stories, but at the beginning of 2020, still working for Lululemon, if you kind of put yourself back in that period of time, we're talking about March, April, May of 2020, the whole world is shut down. Lululemon's returns, DC was shut down, the node in their North American network where they received returns, and returns had accumulated for something 10 weeks or 12 weeks, all US returns, right? The mail's still running. So the returns are coming back. DC shut down. So they're not going anywhere. And so, the director of that facility literally got a call from the local post office. I mean, this is Seattle, right? So it's a big facility. And they said, look, we have 8 truckloads, semi trucks of returns. And if you don't take them, we have to liquidate them. We can't store this for you anymore. You have to take this stuff. So then I get a call, hey, we need a solution here. Where are we going to put this stuff? So I'm on Google, I'm Googling Facebook Marketplace, Kijiji, Craigslist was still kind of popular back then. And I'm like, I got to find some space where we can receive this stuff and just store it until we know what to do with it. And I was so proud of myself. I found this 3PL literally just down the street from the DC in Seattle. And I'm talking to the 3PL owner, and he had marketed on a website. They had space available. And I'm talking to the guy. He's like, yep, we've got space. We can sign it. We're willing to sign a short-term deal. Like, you guys are Lululemon. We know you're going to pay your bills. And he said, by the way, we store coffee beans in this facility. Is that a problem for you? I'm like, no, it's not a problem. I love coffee. And like, what could be a problem? And he's like, well, they might smell like coffee beans. I'm like, that's also not a problem. Coffee smells great. Like, I don't see what the problem is here. And so it's this really like came together very quickly. All the stars seemed to align. It almost felt too good to be true because the space was pretty cheap. Yeah. I'm doing this all remotely from Vancouver. So, in fact, I've never actually been to the building even, 5 years later. And we like send our team over there and we accept delivery of these 8 truckloads of returns, and they sit there for about 2 months while we open up a purpose-built returns processing center here in Columbus. And then we set up the freight and we get all that stuff moved to Columbus. Again, I've never been there physically. I'm doing this all remotely, and it's all on the up and up, and very exciting because it's so convenient and so cheap. And we feel so fortunate that we could find warehouse space in the industrial park that we were in.
Yeah, it seems like a good solution.
Yeah. And then I get a call from our point person at our 3PL in Columbus, and they're like, hey, these returns you sent us, like, they stink. I'm like, what do you mean? And they're like, well, it smells like everything we've got so far smells like moldy gym shoes, just really off-putting odor. I'm like, well, that's strange. I mean, they've been sitting for a while, but I don't think they're moldy. Like, they've only been there a couple months. And long story short, I came to learn that the coffee bean warehouse was storing green coffee beans, not roasted coffee beans. And you wouldn't know it, but green coffee beans smell like moldy gym shoes. They don't smell like wonderful, luxurious, warm, comforting aroma that we associate with coffee. They smell like you put your gym clothes in a duffel bag and you seal that duffel bag in a Ziploc bag and let it sit for a month and get moldy, and then you open up the bag. And so we had something like 80 to 100,000 units where the smell had permeated the shipping bag, it had permeated the inner poly bag, and had made its way into the garment. And we had to like work with a specialty 3PL in Columbus, who I still have a great relationship with after all these years, thank God, and literally had to like take all this stuff out of bags, and we're talking 100,000 units, and like hang it up and run fans on it for like a week to just like air it out and get the odor to come out of it.
Oh man,
so
sounds like
yeah,
a nightmare.
You think about like the cheapest option having costs later or ramifications later. That's definitely a scenario where, again, it was a bit of a like thing that happened in a bubble, right? It's COVID. I'm not on site. If anyone had gone on site, we would have noticed right away, hey, this isn't going to work. Something's not right here. But that feedback loop wasn't really in place with the team that went there and unloaded their returns. And we ended up with 100,000 units of stinky returns that we had to deal with.
Earlier, the cheap option of Facebook Marketplace helped you be able to build the 3PL and get started without taking on a whole bunch of capital or a bunch of debt. In the second story, the cheapest option ended up hurting you quite a bit just because of the unknown. With Lululemon, you had to deal a lot with returns.
Yep.
And that seems to be a hot topic among 3PLs lately.
Yeah.
What are some of the different stories or experiences that you've had with brands or companies dealing with returns?
I think the common thread between those first two like scenarios we talked about, like on the one hand, being really flexible and like sourcing the cheapest option to build an operation and that working out generally very positively. And on the other hand, sourcing something that was inexpensive, being open to a creative solution, finding something inexpensive turns out kind of burns you in the end. The common thread between the two of those is really like pressing into the details to make sure that you're not going to regret the decision later. And so in that first case, being someone who has spent my entire career building warehouses, I have a high level of confidence that I can look at a palette of like random warehouse stuff and like know what it is. And I know how it goes together, and I know what needs repaired, and I know where to source the parts and pieces. So that's an area where like I have a high level of expertise. And so I can get into the details very quickly and easily and like assess that deal. And then in the second scenario, there's obviously like a confounding factor in that it was the spring of 2020 and no one could go anywhere. In a normal scenario, I would like to think I would have visited the site before we signed the contract on it.
Yeah.
But again, because that like due diligence wasn't done, that's the reason we got burned, right? There was no diligence being done on that deal. In the returns world, it's really surprising the frequency with which I talk to brands that really have no idea what is happening with their returns. And it runs the gamut of like, you know, on the one hand, if you're an early stage startup, I can see that you just like, you know, you're on Shopify, you install the Loop app, like returns just happen and customers get their money back. As long as the return rate isn't too high, you kind of don't care about it. You know, you just build it into the cost of goods and you're focused on growth. But then every once in a while, and very recently, I'll talk to an enterprise brand, and I'm talking this one in particular I'm thinking of, you know, $250, $300 million annual e-commerce business. And they were working with a 3PL who did not process their returns for 3 years.
Wow.
And, you know, you can scratch your head and be like, oh my God, how could you let that happen? Well, in the world of e-com native brands, like this particular company, they only have 12 or 14 US employees. They're very small. So when you think about their efficiency as a business, they're very efficient, right? They're $300 million business with like 12 or 14 people. They make like one category of product. They do it very well. They do it at a very high volume. And their focus is really like margin maximization and like running efficiently to be competitive at a slightly lower than average price point. But the operator in me is like, I can see like 3-6 months. But how do you go 3 years and not, first of all, as a 3PL, like how do you do that and like look your client squarely in the face and like every QBR, you tell them how great things are going. Like no one's asking like, hey, have you processed any returns? Like nobody even thought to ask that question.
Yeah.
But also on the brand side, like how are you not, how does that happen? Like, how do you get to that point? And I'm telling you, Scott, like at least once a month, I have a conversation like that. And I'm not even, you know, our business is, you know, I'm not like McKinsey. I'm not talking to hundreds of brands a month. If I talk to a dozen different brands in a month, that's a busy month for us. So 1 in 12 I talk to, it has a similar story of like our 3PL just didn't process returns. And I still don't have a good answer to that. Like, wait, tell me how that happened. I don't understand how that happened. But like, even in this world of e-com native brands where, you know, you can start a brand with really almost no supply chain experience and you can be fully dependent on your international vendor and vendors and fully dependent on your domestic 3PL to kind of make everything work. You still have to be asking those like critical questions. And with all due respect to some of those brands, some of which have become clients, some of which are still prospective clients, like that's just not acceptable to not know what's happening in your supply chain. I understand that like maybe you don't have a dedicated supply chain executive on your team because you're an e-com native brand, but like, man, you've got to be asking those questions and like, what's happening with my returns? You've got to start thinking about your returns as cash, and it's cash you can't deposit unless the returns are processed. And if they don't get processed for 3 years, that's a whole bunch of cash that like you can't put in the bank.
Right. It's crazy how small things at scale can add up.
Yeah.
And especially at the beginning stages, it's really not that big of a deal. But as you scale and scale, so do your problems. And that can add up quick. Even though percentage wise, it can be hidden in the reports because really it's not that big of a percentage. But if you look at the actual real value, imagine if that money had been reinvested into different things in the company.
Or imagine,
it's hard from an executive standpoint to sometimes keep that perspective.
Yeah. Or imagine if the revenue from the sales of those units could be reinvested. When you're a high growth brand, I can totally see how this would happen. You know, every PO you're cutting is bigger than the next, and you're in such a growth cycle that like you don't even realize that 10 or 15% of units that are coming back aren't actually making it back into stock because you're growing 20 to 25% a quarter or a year. But still, like, you got to ask those questions. You've got to get boots on the ground. It can't be a virtual QBR. And really, as an operator, like, I want our clients to come visit their operations. Like, I want to have that type of partnership with them because that builds a relationship that allows for, you know, mistakes don't turn into contract termination. You know, where this particular 3PL, the minute this was uncovered, it was like immediate breach of contract. Like they got their legs cut out from under them. And I think rightfully so. Like from a 3PL perspective, it's like totally unacceptable.
What could 3PLs do to better tackle that problem? Or how can they build systems and processes to make sure they're having the proper audits so they don't lose clients because of something such as not taking in the returns?
Yeah, there's a couple things that come to mind. I'm a big advocate of this philosophy of like extreme ownership. There's a book out there by Jocko Willink, who's an ex-Navy SEAL of the same name. It's called Extreme Ownership. And the idea there is like adopting the mindset that you are responsible for everything kind of in your periphery, even if maybe some people would say it's not your responsibility. By adopting the mindset of like, it is my responsibility, then that might change how you would interact with your customers. So when you think about the scenario of like, I'm a 3PL operator and I haven't processed returns for 3 years, like if you're in extreme ownership mindset, that could never happen as an operator. I don't know the history there, right? I'm only getting one side of the story. I've never talked to the 3PL in this particular example, but like maybe there was a time early in the relationship where the brand said, hey, we don't need you to do anything with these. We're refunding, on carrier scan, and like just set them aside.
Right.
Cool. That happens all the time. That's not unusual. But at some point, you have to, as the operator, you have to take accountability for the fact that that continued to happen and you never raised your hand and said, hey, brand, you told me this 2 months ago. Is that still what you want me to do? Like you should be asking that question. So, I would say on the one hand, like it is clearly the operator's fault if the brand shouldn't be surprised, if the client shouldn't be surprised. Like that's that extreme ownership mindset of like the client, like I never want our clients to be surprised at an outcome. Or if it's a surprise, it's a positive surprise, not a negative surprise. The other thing that comes from that mindset of like extreme ownership is really this approach of like pressing into the details on a deal. And so some examples for that, one in particular that comes to mind, several years ago, I was working for a really large 3PL. We're talking enterprise grade 3PL. There's 5 3PLs in the top right corner of the Gartner Magic Quadrant. And it was one of those 5. They were getting ready to launch a very high volume apparel operation. The operation was built around the common 5 or 6 like average numbers that a 3PL asks a brand when they're sizing an operation. It's like, what's your average monthly volume? What's your average units per transaction? And what's your average rate of return? And some of those and we always preface that with average, right? For most people, the term standard deviation is not a conversational phrase. So when you say it, I tend to go a little bit cross-eyed. But like as operators, standard deviation and the concept of statistical analysis, even like very basic statistical analysis, like should be part of our acumen. And what you're really saying is like, okay, thanks, you've given me the average, but give me a layer deeper in the data. Let me understand the spread that informs that average. So for this particular operation, 300,000 units a week, like we're talking a high volume operation. It was built around this average units per transaction of like 6 or 8, a pretty high number for apparel, but it's kids clothing. It's cheap. So they tend to buy a lot at the same time. And what we learned very quickly after tens of millions of dollars have been invested in a tilt tray sorter and a tote buffer and all sorts of automation is that for the first 28 days of the month, the average units per transaction was between 1.5 and 1.8. And then on the last day of the month, the last 2 or 3 days of the month, their repeat customers were offered like a redemption period where they could like redeem points that they had accumulated from a loyalty program. And so what would happen is the units per transaction would jump to like 40, like average. So you built this operation for 6 to 8. It's a tilt tray sorter and a put wall at every single pack station. And it's this like Ferrari of an operation sized around 6 to 8 units per order. And then all month long, you're just absolutely like dragging on the productivity side because you're just processing singles all day. And then at the end of the month, you get this huge spike in volume. And then combined with that, the order profile changes just absolutely dramatically. And all of that could have been avoided by asking one question: what's the standard deviation of this average? And that mindset starts with this perspective of like extreme ownership, like taking ownership of those things in your periphery as a business owner, making sure you're writing good contracts, you're signing good deals. Another thing that we talked about, in prep for the show today was like the idea of like commoditized services. And like really like not falling for the trap of essentially bidding against yourself for a commoditized service. If you're a 3PL, like find, especially if you're a new 3PL, or if you're like us, you're like a, I'm not even sure I would call us a regional 3PL. We're a family-owned business with multiple locations. We will not bid on opportunities where we're getting into the world of like nickel and diming our way to a deal. If I'm going to win or lose a deal by a nickel a unit or 10 cents a unit or even 25 cents a unit, we'll just let it pass. Because what that tells me is that the brand is really looking for a commoditized service. And there's a whole bunch of companies out there that will provide that like core pick, pack, ship, for a very low rate. We try not to participate in that market. And moreover, we try and like screen those clients out before we even get to that conversation. And so that's usually in like our first engagement, is understanding their requirements. And if they just keep emphasizing like, oh, it's really simple, it's just pick, pack, and ship, and it's really simple, and they say really simple 4 or 5 more times. So yeah, we're probably not for you. Take that like perspective of confidence to say, this is what we do, this is what we do really well. It sounds like you don't need those services, and so we'd be happy to, refer you to somebody else. We'd also be happy to help you with your RFP. We have an advisory services division, but it sounds like our services, our operational services, are probably not the right fit for you. Because the cost of getting yourself into a bad deal with a brand far outweighs any potential upside that you might have from like winning that contract. It's way worse, and we've been there, so we know.
Right. That seems to be a common warning among 3PL owners who have been in the industry for at least 3 years. They tend to warn that you should develop a niche and stick to what you're good at, and then turn down the clients that don't fit that. Now, from a startup standpoint, that sounds really difficult in terms of like, how do you get there mentally and to have the confidence to turn down clients as you're still trying to build?
I think the linchpin for growing a 3PL, and to maybe frame up that statement, I'm not talking about a investor-backed 3PL. I'm talking about whether you're in the logistics space and you want to expand to 3PL services, or you already are a like independently owned 3PL and you want to scale. To me, the like investor-backed 3PLs, and about once a quarter you hear in the news very publicly of like one of them like going under. They're taking funny money from investors, and they're making decisions that I think you and me and the average person probably wouldn't make. And they're really taking big risks, and we like to think they're calculated risks, but in many cases they're not calculated risks. They're just gambling with other people's money.
Yeah.
I'm talking about the independently owned 3PL that is either just starting or trying to scale. The number one thing that is going to make or break you is your relationship between revenue and space, like physical warehouse space. That is the reality of the 3PL world that will make or break your success, and your ability to manage that interplay of like, how much revenue can we generate with how much space we have? So here's how I like to think about it. I like to think about our 3PL, our services business, the same way that a retailer would think about their store, their physical store. And for me, the metric is, what is my revenue per warehouse square foot? That mindset will help to inform decisions that we have to make about acquiring space or not acquiring space. It will help inform what deals we sign up for and the structure of those deals. And I'll give you like a really quick example. We were running, until very recently, a resale program for an outdoor products company that had very large and very expensive products. And whenever we brought people through that operation, it was really, frankly, like a showroom for us. It's a very visible brand. People knew the product as soon as they saw it. 25,000 square feet of this product is just very impressive to look at. And they're like, people would tell us privately, man, you must really be like killing it with that business. And my response was always the same. Like, actually, it's the least profitable thing we do, because I have this huge facility, but it only takes 6 people to run it. And I can only make so much money as an operator from the activity and the work of 6 people. When in contrast, I've got this, we have this little tiny facility, 8,000 square feet. We just do like small volume returns. I have a bunch of returns customers crammed into one building. And we have at any given time, like 15 to 20 people working there. as a business owner, I make way more money, net revenue and gross revenue, to be honest, from that very small operation with a lot of people working in it than that very large operation that doesn't require a lot of work to be done. On the one operation, I'm basically in the storage business, and there's no money to be made in the storage business. The 3PL business is about doing things for people or doing things for brands. And if you're not doing activity, you can't really generate money. Like, you might be able to cover your lease payment, which is great if you can do that. You know, if you're in the fortunate situation to own space outright where you don't have a lease payment, those economics might change a little bit. That relationship between revenue and space will inform the types of deals that you take on. It will inform the way you write your contracts. And in my opinion, is what makes or breaks 3PLs as they're trying to scale. There's the like fear of acquiring space too early and having that burn rate that you can't really sustain. And then the flip side is like not acquiring space fast enough. And then, you know, you can't service a deal that you might be pursuing because you don't have space for it. It's definitely a give and take.
It sounds like a tricky balance.
Yeah, 100%.
So as we wrap up, let's talk a little bit about where the industry is going.
Yeah.
What's one of the trends that you are most interested in and are keeping an eye on?
Yeah, I mean, this won't come as a surprise, but everybody's talking about returns. There's obviously a variety of pressures on brands when you think about their handling of returns, maybe what has taken place in the past, and the horror stories of like product being thrown away and disposed of, like perfectly good product. And that has a bit of societal pressure. There's also this very enlightening reality, which is that if you start to think about your returns as cash, which they are, it will inform a different set of decision-making criteria as to how you as the brand like operate in the reverse side of your supply chain. It's very tempting to just factor in the cost of returns as like the cost of doing business. It's just like part of your COGS, but you are truly leaving revenue on the table. You know, setting aside the like environmental and sustainability factors, you're leaving revenue on the table. And if you're not thinking about returns as cash, you're missing. I mean, look, the numbers are there. Like the average e-commerce brand has a 20% return rate. At any given time, 20% of your inventory is unsellable. 2 out of every 10 units your supplier provides you or your manufacturer makes for you are unsellable because they're in transit back to you. So the objective should be, in my opinion, to make those units sellable again as quickly as possible. And if you're not doing that, you're just leaving a massive amount of like revenue potential on the table. It's a tricky wicket because a lot of 3PLs don't want to touch returns. They don't like them. Pricing for returns operations can be all over the place. There's a lot of technology coming out now to support returns. And I think like it feels like a bit of an obvious answer, but returns is definitely one of them. I know in the world that you come from, AI and supply chain is, I mean, look, if you see a post you can't go very far on LinkedIn without seeing a post that either talks about returns, AI, or tariffs. If you're not talking about one of those three, you're probably like living under a rock. I feel like my thoughts on like AI and supply chain are probably a whole other episode, but like there is certainly some powerful like computing and analysis that tools like ChatGPT and even Box Talk can provide to their customers. So I think that's a conversation that is very much happening right now that I think if you are not participating in that conversation, you're going to get left behind. I think right now, like the tariff situation is so unpredictable that it's almost not really worth forming a perspective on, because by the time you as a business have made a decision to adjust around tariffs, they're probably going to change. What we're telling clients today is like, yep, it's a thing. It's annoying. It impacts your business. It impacts your economics. Let's make really smart and shrewd business decisions without considering tariffs. Like, let's just make good business decisions first. And then if you have made all the good business decisions you can make, and then you're looking for something, then let's focus on the tariff impact. But making good business decisions in your supply chain, especially on the reverse side of your supply chain, you're going to get a lot more bang for your buck getting returns back to stock as quickly as possible and like optimizing that cash cycle than you will worrying about trying to pre-position inventory to accommodate ever-changing tariffs.
Well, thank you so much for your insights and coming on the podcast. For those listening and are interested in getting a hold of you, how should they reach out?
Yeah, I'm pretty easy to find on the internet. I'm on LinkedIn, Nate Schisler. You can check out our company website, mavencircular.com, spelled just like it sounds, Maven Circular. Yeah, you can find us either of those 2 locations and drop me a line. We'd be happy to chat with any of your audience.
Well, thanks for listening to Fulfillment Unpacked. Every episode, we're all about bringing 3PL operators and industry leaders to share real stories, practical lessons, and strategies that help you run a smarter, more fulfilling warehouse. Keep learning, keep growing, and we'll see you next time.